Jay Powell just confirmed the Fed knows it's out of time, which actually raises the chances of repeating what happened earlier in August. Yesterday in Wyoming, he said, "We do not welcome a further cooling in the labor market," which shows he already knows it's probably gone too far. In fact, he said as much, or at least indicated as much, when he talked about how much room the Fed has to cut rates. What a huge difference in tone now compared to not all that long ago. Gone is all the swagger about strong and resilience in the labor market, replaced with, okay, we're ready to act in a big way on the unemployment rate. In reality, we all know, the markets all know, the Fed is already and always behind developments. But the consequences aren't just about the US economy, what all this means for American workers who are about to get screwed over yet again. What Powell said yesterday confirmed what was behind the global financial volatility from earlier this month, the asset liquidations, the stock market corrections. US recession risk is not something that many bubbly parts of the market are ready for. And when confronted for the first time with a strong possibility, the system instead showed just how fragile it was. And those risky parts are still not ready. And we can tell that by how the system responded in early August and what it has done since then. Starting with, get this, US primary dealers had piled up a record amount of treasuries on their balance sheets. And that's not a good thing, especially what it says about collateral possibilities. Nor is the prospect of a Fed aggressively cutting rates a positive. Again, those two things are actually related. As I said in Thursday's video, rate cuts are never a good sign. They tell us that the weakness is already bad enough that even the central bankers can see it. And that's what Jay Powell just said at Jackson Hole. We now see it too. The repricing of global risk that only got started earlier this month just got another strong and compelling bit of confirmation straight from the Fed chair's mouth. So while taking account of the economic consequences, we also have to bear in mind the potential monetary and financial implications too. Collateral, liquidity, maybe even, if we're not lucky, that other September effect, the bad one, the bottleneck. Recession isn't just about the economy, it screws up a whole range of factors, including riskier parts of the system that were not ready for this very possibility. They were not ready because Jay Powell said it wasn't going to happen. Well, just yesterday in Wyoming, he said, yeah, we see it too. So while everyone was all over Mr. Powell about what he was going to say as far as rate cuts, because right now in this early stage, everyone still believes that rate cuts are a good thing when history conclusively shows that they aren't, what he really said is we're definitely pivoting in September, and the reading between the lines, he probably did want to pivot back in July because things had deteriorated that much. So he says we're pivoting because the labor market situation has indeed changed. We've been downplaying all the warnings all this time, but now it's gotten to the point where we actually can't ignore it anymore. You got to give him a little bit of credit here because at least he's being honest for once. And he's being honest because he's going to have to explain why there may be a large rate cut coming in September. And there's a large rate cut coming in September because the unemployment rate is already at the edge of recession, nonlinearity, that point of no return, if not already beyond it. And history shows, and the data can keep showing that it likely is beyond it, and he's just saying that we've got time to react to it. What he actually said in Wyoming was this: the unemployment rate began to rise over a year ago and is now at 4.3%. Still low by historical standards, got to always throw that in. But the most important part, almost a full percentage point above its level from early 2023. Now, most of that increase has come over the past 6 months, which is this momentum that we keep talking about in the SOM rule and the paper I talked about a couple days ago. But so far, he's downplaying it again. Rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Not every downturn, and certainly not the start of every downturn. Rather, the increase, back to Powell, mainly reflects a substantial increase in the supply of workers. This is not true. I keep showing this chart all the time, and they keep saying it's true when it's not true. The unemployment rate is up as the labor force has plateaued. But back to Powell, a slowdown from the previously frantic pace of hiring. Even so, the cooling in the labor market conditions is unmistakable. So now he's basically saying all this stuff about strong and resilient. Yeah, we can't ignore the unemployment rate anymore, nor can we ignore the momentum in unemployment. We can downplay it as not layoffs and just not enough jobs for a supply of workers, which is again not true, but we can't ignore the fact that the unemployment has made a more decisive move here, and that one that is very typical of a recession process. And so he goes back to, it seems unlikely that the labor market will be a source of elevated inflationary pressures anytime soon. So we don't need to be hawkish like we were pretending a couple months ago, sticky inflation, all that Phillips curve. However, Powell says, we do not seek or welcome further cooling in labor market conditions. And that's the big one. What he says is basically we're out of room. The margin is gone. The unemployment rate has moved too far already, and it is moving much more quickly, which means we're right at the edge, at least according to the Fed and what they're willing to say publicly. And again, since he's always behind, the Fed is always behind, this is not just a small risk that the actual economy has gone beyond that point of no return, over the edge. What the Fed is willing to admit in public to justify the coming rate cuts is simply that we're likely at the edge of that recessionary process. We've gone too far and too fast to deny it any longer. We need to act because the situation has indeed changed. And equally important in all this is notice how the tone has completely changed. As I said in the introduction, Powell was all strong and resilient. Now he's saying the unemployment rate's too high and it's threatening to go much higher unless we do something about it. Now that's where the Fed is really pivoting in this narrative shift, which is important to understand and factor. The narrative is gone for everything's just fine, strong and resilient to now we got to act because the situation has changed and now the economy's on the very verge of recession already. That's an important shift because think about what he's been telling everybody and think about how everybody has been accepting his narrative. As the narrative is changing because the economy has already changed, which means not only is the Fed at risk being behind, but everybody that's followed the Fed is at risk being behind as well. And that creates a whole bunch of urgency. So to try to rein everybody back in, the narrative is shifting from the economy's just fine to, okay, it's not fine, but don't worry about it. We'll fix it. We've got room to cut rates. So back to Powell in Wyoming. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of cuts will depend on incoming data, the evolving outlook, and the balance of risks. We will do everything we can to support a strong labor market, which is no longer strong on its own, as we make further progress toward price stability. With an appropriate dialing back of policy restraint, there's a good reason to think that the economy will get back to 2% inflation while maintaining a strong labor market. That's the whole point. And the reason he says that there's a good chance is because what he says next, the current level of our policy rate gives us ample room to respond to any risk we may face, including the risk of unwelcome further weakening in labor market conditions. Just ask Ben Bernanke and Alan Greenspan how that worked out. What he said was because the federal funds target is up in the 5% area, 5.25% to 5.5%, we've got plenty of room to move rates down aggressively if conditions actually deteriorate. Plenty of room to cut rates aggressively if conditions actually deteriorate. Exactly the scenario that the markets are pricing right now. And as I keep pointing out through reviewing historical examples, these rate cuts are a response to that weakness, which is what Powell is admitting, but where he goes further is in saying that this will cushion the labor market blow and the economic blow so that we don't suffer anything more than a minor inconvenience. When history shows once the unemployment rate gets started, like it already has, rate cuts aren't going to do a damn thing about it. So he's trying to play it both ways. Yes, we see the weakness, but don't worry because we can cut rates, which is exactly what Ben Bernanke said. It's exactly what Alan Greenspan said twice. And in no cases does it work. And that's not just the US. Look at Europe. I went into a deep dive analysis yesterday, talked about the fake rate cuts from the ECB back in the 2011-2012 recession. That didn't work either. Rate cuts don't work, but that's all the Fed has. So as the Fed and Jay Powell now confirms they're going to cut rates, and then also saying that they're going to cut rates because unemployment has already gone too far or likely is about to go too far for the Fed's perspective, how does all this relate to early August? Well, you hear in the financial media, a lot of the financial media, is that it was all about something in Japan. The Bank of Japan hiked rates. There was some interest rate differential screw-ups and everything else. And it caused the yen to surge, and then liquidations in Tokyo that kind of went in other places around the world. But that's not what really happened. What really happened was, as I've been saying pretty much all year, warning, Japanese financial firms have been reaching for yield because dollar funding costs had forced them out of U.S. treasuries into riskier U.S. dollar assets, and riskier assets in other places around the world too. This spreads out everywhere. But their reaching for yield meant that in reaching for riskier U.S. dollar assets that pay a little bit higher return, that in order to do so, you have to assume that what Jay Powell was telling you before was true. I'll buy riskier junk corporate assets, corporate debt, because it pays a higher return, because I believe that Jay Powell is correct about the U.S. soft landing. And as the Japanese firms and the marketplace in general were confronted with more and more evidence that the soft landing might not happen, they reacted in the way, well, the Bank of Japan had warned about a couple years ago. I brought this up in a video back on June 24th. In 2019, the Bank of Japan, in its financial stability report, said, we need to keep a close eye on these Japanese banks and Japanese financial firms who are building up these large positions in risky U.S. dollar corporate junk assets. And the reason is because, well, here's what the report said. Notably, in recent years, Japanese banks, particularly major banks, have increased their investment in leveraged loans to borrowers who have low creditworthiness, as well as in collateralized loan obligations, CLOs, backed by these loans. So they're junky loans packaged into securitized products. The overall credit quality of the overseas loan portfolio has remained high, and most of the CLOs that the banks hold are AAA rated tranches. And that's not the case anymore. Over the last couple years, the Japanese banks themselves, I talked about this with Nichiren Bank, the Japanese banks themselves have been moving up the risk curve. No longer just AAA, now they're buying AA and single A and who knows what beyond it. And the rationale for doing that was, I get a little bit of extra yield from going into AA and single A, and there's no additional risk because Jay Powell says the economy is just fine. But here's the thing, what the Japanese Bank of Japan's report said back in 2019, the very next thing. However, attention should be paid to a risk of a decline in ratings and market prices of CLOs in the case of a sudden change in economic and market conditions, which is just what we had really June, July, and heading into August of 2024. A sudden change in perception of economic conditions that led to everybody heading for the exits because the Japanese banks that are buying all this are well aware of these risks. And it continues. An analysis shows that this is mainly due to the increase in common exposure, example, the degree of overlap in borrower categories between Japanese major banks and overseas globally systemically important banks, or GSIBs, for leveraged loans, which have a higher credit risk and thus raise concerns regarding vulnerabilities in a recession period. So what the Bank of Japan was warning about 5 years ago is basically that holding CLOs, overseas US dollar CLOs, is not going to be a very good idea during a recession. It was not a good idea holding AAA rated. It's sure as hell not going to be a good idea holding double or single A rated or worse. There's low creditworthiness, vulnerability to ratings changes, illiquidity in the marketplace, and also, as that last part was talking about, globally synchronized. When there's a recession fear, these markets shut down, which means there's no market for them when the feces hits the fan blades. In other words, if things start to look bad, everybody's going to be running for the exit at the same time, which is what happened earlier this month. And it started before we got to August 1st, 2nd, and 5th. You could see it coming in a whole lot of different ways in a lot of markets. The narrative of a soft landing, the narrative of a strong and resilient labor market began to unravel in the fixed income markets, and you could see this having an impact likely with these Japanese holdings of riskier assets, and then the consequences that rippled from there, even before we got to early August. I talked about the collateral indications that showed up in the middle of June which seemed like it was related to Europe. We had swap spreads, for example, that absolutely plunged. That was June 13th, 14th, on through June 18th. The 10-year swap spread just went way down and then went lower from there through the rest of June. The 5-year and 30-year maturity swap spread did something similar, nearly the same thing. We also, as I pointed out back in June, we also saw that dealer holdings of U.S. Treasuries, a key collateral signal. When dealers hold a lot more U.S. Treasuries, they're doing so out of a defensive mechanism to make sure they have collateral in inventory, or as a proactive step to take advantage of the fact that they believe soon enough people in the marketplace are going to be willing to pay a huge premium, because collateral is short, to rent out the Treasuries that dealers end up holding. So dealer holdings of U.S. Treasuries surged to a multi-year high of $216 billion during this middle period in June, which seemed again like it was related to the election chaos that was going on in France at the time. Remember, there's the spreads between French government bonds and their German counterparts blew out, which seemed like it would be consistent with these collateral indications. But around the same time, in fact, of next week, June 17th and 18th, the 4-week Treasury bill yield suddenly plummeted. That's a collateral indication, which you could chalk that up to being just a spillover from the European stuff the week before. But even so, that kind of collateral squeeze should not have happened with so many Treasury bills being issued, which suggested, along with dealer hoarding, that this was a substantial collateral shudder, call it that. But where it started to deviate from Europe, as Europe started to calm down the rest of June 17th, we also see the 3-month Treasury bill yields start to go lower, which was suggesting that the market, in the real money market, the moneyness of Treasury bills, in the real money market, participants were beginning to price rate cuts at that early stage. Remember the Fed back in the middle of June, that we're still worried about sticky CPIs. Here, the marketplace and bills was responding to what was going on behind the scenes, in the shadows, and in the black hole of the Eurodollar system, all this collateral stuff, thinking this is not going in the right direction. And this is not just about the 3-month Treasury bill yield going down and longer-term Treasury bill yields going down. That's not about European elections. And of course, they continue to go lower from there. So it was about the building recession fears and monetary consequences from those recession fears hitting, even at that early stage, likely some issues with the Japanese holdings and Japanese funding. So the market was already moving in this direction. We already got macro data that was confirming everything negative about the U.S. economy and the labor market. Remember, we had JOLTS came out on the 31st, August 1st, jobless claims, and then August 2nd, the big one, payrolls and the unemployment rate. So the market was already moving. The whole system was already moving in the direction of weakness and fragility, risk aversion, and then the labor data comes out and confirms to these Japanese players Jay Powell was wrong about the soft landing, so they started heading for the exits, and the exits were not nearly wide enough. It triggered a whole wave of other consequences in the financial system, liquidations, and collateral shortages. It all comes down to U.S. recession. And U.S. recession isn't really just about U.S. recession. As I've been saying in a lot of different videos and writing in our deep dive analysis, U.S. recession means a lot more than just a business cycle or a short-term rise in unemployment. But that's a separate issue from what we're talking about here. What we're talking about here is many risky parts of the global system just were not prepared for the idea that the U.S. could possibly hit a recession and what that would actually mean, short and long run. Nobody was prepared for it. So when confronted with growing evidence that showed, yeah, we're really heading in the wrong direction, it triggered a backlash, starting with these Japanese positions in risky corporate credit. Having been warned years ago already by the Bank of Japan, of course, understanding the risks themselves, they realized that they don't want to stick around in case this recession fear gets confirmed, as it's being doing right now in Jackson Hole. They don't want to stick around in these illiquid, risky securities when things start going wrong. So as soon as it looked more seriously like it was going to start going wrong, they ran for the hills. Except you can't just run for the hills. You got to go through the exits. And during these periods, as we saw on swap spreads and dealer holding of treasuries, that was telling us the exits were getting narrower and narrower and narrower. So as the Japanese tried to get themselves out of this potential recession risk, it triggered a whole wave of backlash all throughout the system with a lot of focus on the Japanese. Well, there's reasons why that is, and that's not part of our discussion here. But essentially, it was a global systemic backlash to repricing U.S. recession risk. And now we have Jay Powell, the Federal Reserve Chairman, basically confirming, first of all, that what he said before was just complete nonsense. Yeah, we downplayed all of the risks of the U.S. economy. We said strong and resilient labor market. Now they're saying complete 180. Yeah, the unemployment rate's gone too far. We don't want it to go any farther. So that's why we're pivoting in rate cuts. But all that does is further confirm the recession risk is real. Not only is it real, it's immediate. So all of the stuff that happened early in August based on that recession risk is at risk of happening again because the Fed is further confirming everything that was behind it. So while there's a complicated series of steps here, what we should be paying attention to is not just the fact that the Fed is going to be cutting rates, but how the rate cuts play into confirming these downside cases. And therefore, what the markets have been saying between early August and now, by not really changing their stances, not really changing their spreads, everything has been kind of moving sideways since early August. Still high degree of risk aversions, meaning narrow exits. Further recession confirmation, further risks to these riskier parts of the marketplace mean higher chances for more liquidations. And this is happening, of course, as we head into September. So Jay Powell didn't reassure the public in the way that he thought by saying, we've got this, we've got lots of room to cut rates, because what he really said was, everything the markets have been telling you, I now see most of it too. If you want to dig further into the CLO issue and how it relates to Japan and Japanese investors, we did that a couple months ago in the video linked below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.